Hello. Today, gold reached over $1,200 per ounce, and this is not indicative of any increase in the supply of gold, but rather the increase in the money supply by the Federal Reserve System. Uh, this is increasingly devaluing the dollar. Now, we might ask ourselves, though, is Bernanke, chairman of the Federal Reserve, a wolf or a guard dog? Because during this financial crisis, the Fed propped up failing banks. They seemed to prevent a full-scale financial collapse. But this may be part of the doctrine of too big to fail. These certain banks just have so much holdings that they just cannot be allowed to fail. Now, the Federal Reserve's key objective is supposed to be low inflation and to maintain a basis of inflation above 1 or 2%, and this therefore means that they would wish to not have such a loose monetary policy as they have done. But if we look to their role as a lender of last resort to these banks, we also must look at their role as regulator of these banks, and here is a deep conflict of interest, right, and a moral hazard. The Federal Reserve System is a collection of 13 banks, which are then made up in turn of commercial banks, community banks, and state-run banks, such as Philadelphia, such as New York, such as San Francisco. Now, these banks are supposed to have some sort of supervision by the Federal Reserve Board in Washington, and this has both a managerial and legalistic role in making sure that the banks do not break the law. But then again, the Federal Reserve, in a sense, asks Congress to provide the acts that it needs to do that job, and so therefore Congress is obliged to, the US Congress that is, and the Senate is obliged to act on the advice of the Federal Reserve Chairman and the Board of the Federal Reserve. There's again a conflict of interest, because although the Federal Reserve might be very open and have an independent auditor, provide statistics on its website, and it also tells Congress what it did 3 weeks after it makes a supervisory decision. There's still the flow of information has to be asked for. Congress is not directly involved. Okay. Also, the different banks within its system are rated in 3 classes. There's the community banks, the commercial banks, the investment banks, and those then choose the board for that particular region that the Federal Reserve System operates in. Those then choose the Federal Reserve Board, which in Washington. So throughout, the regulator, the regulatee, is choosing the regulator that regulates them. Okay, so there's a clear moral hazard. There's also a clear moral hazard in the fact that the Federal Reserve has broke the law for the fact that it has been buying and selling investments and securities and bonds, which are not backed by the US government or insured by the US government. So therefore, when Jim Bunny, of the senator of Kentucky, said that he's not for backing Ben Bernanke's renomination, which is breaking the political convention, because the president backs the Federal Reserve chairman, which is another political convention, and no one really is supposed to criticise it. But the financial crisis has got to such a stage that he has gone beyond that political convention. So maybe a new political convention will be set that will regulate the Fed. Now, Senator Senator Dodd of the Federal Reserve Investigatory Committee of the Senate was highly critical of the Federal Reserve, and he was driving towards saying that the Federal Reserve should be split from its regulatory and supervisory role, from as well as having a separate monetary policy. Right now, this would be similar to most central banks in Western Europe, such as the Bank of England has the Financial Services Authority running in conjunction with the Bank of England, and the Bank of England's role is supposed to be some supervision, but mostly monetary policy, of which it has to, every time inflation goes above 2% or the target set, which thus affects interest rates and inflation, they have to send a letter to the Chancellor and explain why this has happened. Okay, but it's still taking away from the democratically elected government any role over the supervision of monetary policy. That is the amount of flows of money into the system, and all fiscal, that is spending and taxation, will depends on the monetary policy of the central bank. And therefore, when the Federal Reserve or the Bank of England says it is the lender of last resort, when banks are so over leveraged in terms of their debts and their bad investment decisions that they cannot get any more credit or liquidity into their portfolios, then the Bank of England is the only one who can lend. But the Bank of England's lending is dependent upon pushing up interest rates, which we then have to pay back into the banking system. So it is the creditors, which are the taxpayers, who are the lenders of last resort. And yet, so shouldn't we, as the people who will eventually pay either way, have some role over the central bank? It's some way of auditing the central bank, and isn't that the role of government? The first democracy was Athens, and the first temple of the Athenian democracy was the Parthenon, and that was effectively the holdings of all of that society. That wasn't a temple for religious reasons, but it was a bank. Okay, that was the bank of the people of Athens, and so therefore they had a right as the democratic electors of the Athenian Council over that bank. And yet today, in a modern democracy, we do not have this role. Okay, the Federal Reserve or the Bank of England is completely independent in their way that they set monetary policy, and this is because of a deep schism between the people and the economists in the understanding of economics, and this is why our democracy is failing. Okay, until people understand economics, they're going to keep continually being screwed, and that's the only way to say it. Might do a part 2 on this, I'm not sure. I've got to do some more research.